On. Okay, so sorry guys, just for the sake of the recording, I just slightly start again. So welcome guys, my name is Vinay Patel. I'll be your lecturer and subject coordinator for this class, so welcome. And so that's a little spiel about me. Sorry for the guys on the recording, I forgot to click the record button. That's enough about me. What about you guys? So let me just get this going. Okay, so I've launched a poll in the class just to help me understand a little bit more about you guys, and most of you have started completing that already. The purpose of the poll is just to help me understand if you guys are in your first year of uni, if you have any maths, finance, accounting, economics, and so forth background, if you've studied those things before, and if you have some idea as to what majors you want to do. So I'll just leave that poll open for now, but it does seem like a fair few of you are still unsure about which major you want to complete. So if you do have any questions in particular about the finance major, feel free to get in contact with me and hopefully I can give you some more information and make that decision for you a lot easier. Okay. So I'll just give you guys a few more seconds if you want to fill out the poll. And this is my first time running a Zoom class, so just bear with me whilst I get used to all the shiny buttons and how to operate this thing and so forth. Okay, so it seems like a fair few of you want to do a finance major. That's fantastic. You guys are already my favorite students. And it seems like a few of you at least are Liverpool football fans. So salute to you guys. Congratulations to you and me, because I'm also a fan. So that's very good. And a fair few of you would support Liverpool if you were to get a HD in this class, which is also nice as well. Okay, so let's get into some finance. So just to introduce you to some very basic sort of finance concepts, we're going to start with sort of a snapshot of Apple. So most of you guys will know what Apple does, right? They sell iPads, iPhones, MacBooks, and all of those sorts of things. Does anyone know what the trading symbol for Apple is? So if you were to go on the stock exchange and trade an Apple, does anyone know what the 3 or 4 digit code for Apple would be? If you do, just pop it into the chat window. So very good, Mariam, Kieran, and so forth. Okay, so the trading symbol for Apple is AAPL. Okay, so it's a short identifier to identify what Apple is on the trading or the stock exchange. And as we know, because most of us have Apple products, for example, I've got an iPhone right here. Okay, so we know that they operate in the technology and consumer electronics industrial space. So if you wanted to buy Apple today, so this is, I think, yesterday's share price. If you wanted to buy Apple, you'd have to pay $373 or so to buy Apple. And does anyone know what this word here is, the NASDAQ? Does anyone know what that is? Has anyone heard of it before? If you have, just pop it into the chat box. Any takers? Okay, so the NASDAQ is actually an American stock exchange. So it's one of the major US or United States stock exchanges. Marian's got like the full definition there. The NASDAQ actually stands for the National Association of Securities Dealers Automated Quotations. It's quite a mouthful, but in essence, it's one of the major stock exchanges in the US. And it turns out that Apple currently has a market capitalization. So the market capitalization of Apple basically represents what the value of Apple is as a company. And it's approximately valued at $1.62 trillion. So I put a T there for trillion. So that means there's 12 zeros on there. So Apple is one of the largest companies that exist in the world right now. So it's massive. So I'll talk more about market capitalization later, and you can calculate it. But basically, it's how we as finance people or as investors can determine whether Apple is doing a good or bad job. Okay, if its share price and its market cap are going up, that's a good thing. If its share price and market cap are going down, that's a bad thing in the finance world. Okay, and has anyone here, does anyone know what dividends are? Have you ever heard of this word before? If you have a go at just popping it into the chat window. Okay, very good, Jason. Very good, Patrick, Joshua, you're all on the right track, okay? So dividends are basically cash that the company pays to its owners, which is known as its shareholders. Okay, so if you're an owner of Apple or a shareholder in Apple, Apple will pay you around $3 for every share that you hold in Apple every year. Okay, so dividends are a good thing if you're an investor because it's a form of reward that you get from investing. Okay, so the last thing I have here is beta. This is a little bit more complex for our very first class, but we're going to talk more about this in subsequent lectures. Basically, beta, this guy here, is a measure of risk. Okay, so higher beta means higher risk. Risk just means how uncertain are you about a particular investment. Okay, so we've covered lots of things there, and we'll cover all of these things again in subsequent lectures or even in today's class. So I just wanted to quickly introduce you to some finance things. But I have a question for you here. So the question is, if you guys invested $1,000 hypothetically in Apple stock in 1980, how much do you think you would have today? So what we've got here is a big picture of the Apple stock price over its entire life. Okay, so Jose is already saying a lot, which is very good. So at the start of the graph here, you've got we're in about 1980. Okay, that's when Apple started. And then if we go all the way through time up to today, we can see that Apple's stock price has basically increased from very close to zero, okay, all the way up to around $375 or so dollars. Okay, so a lot of you, if you have some guesstimates, feel free to pop them into the chat window. But one thing is for sure is that you would be pretty rich if you invested in Apple stock. Okay, you would be, I could just fill it in here for you. You would be freaking rich. Okay, so the actual answer is almost $10 million. Okay, now to actually get to that number, it's a little bit more complicated, and rather than sort of dive into that, we'll learn about these types of calculations later on. So we'll leave that for then. Okay, but long story short is you would have earned a lot of money. Okay, which is good if you're a finance type of person. Okay, so before sort of diving into the course a little bit more, if I was to summarize finance into 3 things that I think you should know, these are the 3 things that I think you should know. So the first one is called the time value of money. Now, we're going to spend 3 lectures on this. So from next week onwards, we're going to spend 3 lectures looking at this. However, here's a very simple example to sort of indicate what it means. So again, it's a hypothetical. If I gave you guys 2 options, if I gave you $500,000 today is option A, and option B is I would give you $1 million in 40 years time, which would you pick? Okay, so have a few moments to think about that and pop your answers into the chat. if you've got a view on this. So we're sort of seeing with the chat, we've got Stephanie, Patrick, Nicholas, Ruby, and here we go. The chat's going ballistic. Chris, Jeremy, Anthony, a lot of you guys are going for A, which is fantastic. Okay. And a lot of you guys have put the correct answer in already as well. And a lot of you have answered the question very correctly as well. So that's really good. So the correct answer is A. Okay. You would rather take $500,000 today. And the simple reason for that is, as a lot of you guys have said, and next week we're going to introduce you to this formula which kind of makes this more explicit. But essentially what you could do is you take this $500,000, you pop it into your savings account, earning roughly 2% per year. You leave it in there for 40 years and you would get about $1.1 million in 40 years time. Okay, so you'd rather have $1.1 million in 40 years time than $1 million in 40 years time. Okay, so very good. A lot of you guys got the correct answer. Very, very good. And just to elaborate on that, a nice way to, if I had to summarize the time value of money in one sentence, it would simply be $1 today is worth more than $1 tomorrow. And the reason why that is you can invest that dollar and you can earn interest as a reward on that $1. Okay, so fantastic start, guys. Okay, so as I said before, we're going to look at the time value of money for around 3 lectures going forward. So we'll talk more about that then. Okay, so the next thing I want to introduce you to is called diversification. Now, I've got some more snapshots of some companies here that I'm going to talk about. Does anyone know what the trading symbol for Qantas is? Okay, very good. QAN is the trading symbol for Qantas, and I'm assuming you all know that Qantas is the Spirit of Australia. Okay, so it's a plane service provider. We'll talk more about Qantas later, so we'll skip this for now. And I'm also, here's a little bit of a snapshot of Coca-Cola, and I'm sure you all know what Coca-Cola does. They sell the sweet, sweet soft drinks that we love to drink. It turns out that the trading symbol for Coca-Cola is CCL, okay? And again, we'll talk more about Coca-Cola later, so we'll leave that for now. So the reason I introduced you to Coca-Cola and Qantas is because I want to talk about diversification, okay? So basically, diversification allows us to reduce our total risk. And it allows us to do this by investing in different flavors of pie rather than a single slice or a single flavor of pie. Okay, so another way of saying that is diversification allows us to reduce our total risk by investing in different types of stocks rather than investing in one kind of stock. Okay, so here's an example to help you understand diversification. So let's say we made an investment into Coca-Cola stock only, okay? And let's say the government increases or introduces a sugar tax on the sale of Coca-Cola because it wants to reduce the sale of soft drinks because it's bad for our health. So what that might do is that could cause Coca-Cola's sales to decrease. It could cause their net profits to decrease. It could then cause its share price to decrease. And if we owned Coca-Cola, we would lose money on Coca-Cola, which is bad. Okay, so that's bad. Alternatively, what we could do is